Welcome to the June Spotlight on Investments, brought to you by producersweb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Investments is sponsored by Financial Independence Group. Our products are strong, but our strength is in our people. For more information, please visit joinfig.com. It would be unfair to hold Moody's Investors Service and Standard & Poor's Corp. Liable as underwriters of securities offerings needing their ratings, according to U.S. District Judge Jed Rakoff. Rakoff issued the opinion after rejecting fraud claims by investors on the safety of $63.4 billion of mortgage debt. On March 31st, he dismissed a class action claim against the credit rating agencies, as well as several other financial companies. He rejected the plaintiff's contention that the agency should effectively be treated as underwriters because their ratings were necessary in order to distribute the securities. According to Rakoff, quote, "There is nothing in the complaint to suggest that the ratings agencies participated in the relevant undertaking, that of purchasing the securities, from the issuer with a view to their resale," unquote. The Securities and Exchange Commission, or SEC, and the Financial Industry Regulatory Authority, or Finra, are warning investors to beware of stock scams that promise easy profits from cleanup efforts related to the catastrophic BP oil spill. The SEC and Finra noted that while some of the companies touting their role in the cleanup may be legitimate, others could be bogus operations that are only looking to clean out unsuspecting investors. In a recent action, the SEC suspended trading in shares of Act Clean Technologies, Inc. of Huntington Beach, California. The SEC took this action because of questions about the accuracy and adequacy of publicly disseminated information concerning, among other things, British Petroleum's purported expression of interest in using a so-called oil fluidizer technology licensed to ACT's wholly owned subsidiary for use in cleanup operations in the Gulf of Mexico, and the purported result of field tests finding that the oil fluidizers are effective for use in cleanup efforts in the Gulf of Mexico. Hedge funds endured their worst month since 2008 during May, losing an average of 2.7% through May 27th, according to the HFRX Global Hedge Fund Index. May saw the sovereign debt crisis in Europe trigger declines in stocks, the euro, and commodities, while the gap in yields between U.S. short-term and long-term debt narrowed. The decline was the largest seen since November 2008, when hedge funds fell 3% in the wake of Lehman Brothers bankruptcy. According to Hedge Fund Research, Inc., nearly every strategy lost money during the month, with some of the most well-known funds seeing their yearly gains completely erased. For example, Paulson's Advantage Fund fell 6.9% through May 21st, bringing it to a year-to-date loss of 3.3%. I'm Paul Wilson, and thanks for watching the Spotlight on Investments. To see more video spotlights on your favorite products and practices, find them on producersweb.com and browse by topic.